Okay, hi guys, and welcome back. Today we're going to finish our external sources of finance. So to date we've been looking at external sources of finance, but those debt sources of external finance. So when an organisation goes outside the organisation to access debt, either short-term or long-term. So for a period up to 12 months, using such a thing as an overdraft, or for a period greater than 12 months when they might use something like leasing or finance or an unsecured note. Okay, so today we're going to look at equity finance. Sometimes students think, well, equity finance, is that not a source of internal finance? But it's not, because it's the organisation going outside of its borders or outside the business to see generally members of the public to get finance from them through the issue of shares. And we focus predominantly and only on ordinary shares. Okay, we'll also look at rights issues, placements, share purchase plans, as well as the role of private equity. Okay, so what actually is equity? Well, equity is the sale of shares, the original sale of shares by a company to members of the public in an effort to raise finance. And in Australia, those shares are traded on the secondary market, that being the Australian Securities Exchange, or the ASX. When those shares are sold for the first time, you might remember from Year 11 business studies, that occurs in the primary market. Some examples there of examples of public companies, or the original issue of equity, is Qantas. Back in 1995, they became a public company. They were previous to that a government-run enterprise, and they listed for $1.45 billion. So all shares were sold in that company to the general public. And Atlassian, end of 2015, December 2015, they became a public company, listing in the US and raising about a bit over $1 billion for each of its two founders, and I think valuing the company at about $6 or $7 billion. Okay, so we'll start off with ordinary shares. So what are ordinary shares? Well, they are just when shares are sold in a company that give those shareholders a small percentage of that company. It gives them voting rights. It gives them the opportunity to hopefully receive dividends. And at the annual general meeting that a company must hold by law every year, it gives them the right to vote in proportion to the number of shares that they hold. So if you're a big institution like a big super fund and you own 15% of a public company, you effectively are voting you're voting in a block of 15% against all other shareholders. So there are some other types of there are some types of share issues which we need to understand. Firstly, a new issue. So that is when shares are sold for the first time. So the example of Qantas, that was a new issue of shares back in 95. Telstra, when they listed as a public company, they were new issues. Commonwealth Bank did the same thing. Atlassian, and there are other examples of companies when they sell shares for the first time, that is a new issue of ordinary shares. A rights issue is a different type of raising equity, so accessing equity as an external source of finance. And a rights issue is when existing shareholders, and they must be existing shareholders, are given the opportunity to buy new shares in proportion to the number of shares that they currently hold, and often at a discount to the current market price. So it's very important to understand that a couple of things. You must, to participate in a rights issue, you must be an existing shareholder. You are entitled to buy shares in proportion to the number of shares that you hold, and generally those shares are sold at a discount. There are many rights issues that have occurred over time. One that you may want to research is Wesfarmers. Back in 2008, 2009, the company was getting a bit of pressure from its banks to increase the amount of equity that it had because it had taken on a lot of debt finance to purchase Coles. They undertook a rights issue where they offered existing shareholders the opportunity to buy more shares than in proportion to the number they already held, and those shares were sold at quite a significant discount to the last traded price. I think from memory the trading price at that time was around $28, and those new shares that were offered in that rights issue were offered at about $22, so quite a considerable discount. And that's done to ensure that all those shares are sold. Okay, so that's one type of new finance that a public company might use. You've got a couple of other types as well. A placement is an allotment of shares, and the difference between a placement and a rights issue is that you don't have to be a current shareholder to participate in that placement. And the placements are often large amounts of shares sold quite quickly, and I mean quickly that it might be announced Tuesday afternoon that Qantas is going to undertake a placement, and that placement might be completed by Wednesday morning, so the next morning. Often sold to large institutions, so they've been your big super funds, and often in quite large amounts of money. So you might be raising $100 million almost overnight by issuing new shares to some targeted investors. It might be offered to individuals, but generally those individuals would be wealthy or high net worth individuals. And a share purchase plan is another type of new issue of equity, and is generally offered to existing shareholders in specific increments of either shares or dollar value. So, for example, you might be a shareholder in Qantas, and they might offer you the opportunity to buy either $5,000 worth, $10,000 worth, or $15,000 worth of shares in that particular share purchase plan. Alternatively, they might offer you the opportunity to buy 1,000 shares, or 2,000 shares, or 3,000. So share purchase plans are to existing investors, and generally in very specific amounts, either in dollar value or in relation to the number of shares that they are offering. And generally, like with a rights issue, the price of those shares is generally at a discount to the last traded price. And I say the last traded price because for a rights issue, for a placement, and for a share purchase plan, the shares that are the public company shares will go into a trading halt while that raising of equity occurs. So they will stop trading for a period of time, and once the new shares have been sold, then the shares in that company will begin to trade again. Okay, the last type of finance, which is an equity source of finance, is private equity. Private equity are generally large investors or investing companies who have been given large amounts of capital by individual investors, and generally high net worth individuals, so wealthy individuals. They're given that money to invest in companies, and it's their choice about what sort of companies they invest in. In return, they generally will take up potentially some sort of management of the business. They may well sit on the board and be quite prominent on the board of directors. And generally the private equity is investing in businesses that are private and are not listed on the Australian Securities Exchange. Often those private equity firms will invest into a business with the money of their clients, undertake some reforms of that particular business, have it improve in terms of profitability, and then often either sell that business or list it as a public company. Okay, so they're the main types of equity as an external source of finance: new issue of ordinary shares, rights issue, a placement, share purchase plans, and also private equity.